What if I told you that I got profitable when I understood that it doesn't need to be complicated? After years of backtesting and live trading, I developed a system where I understood why 99% of traders are actually losing money, and I learned how to take advantage of it. So in this video I will give you exact steps on how you can use this fair value gap strategy so even a complete beginner could master it. So let's get into it. Alright, so before we actually get into the video, I just want to show you my profits and my win rate from using this model. So this model has about 84% win rate, and you can see right here this month particularly had every single week in green, and you can also see me crossing $100,000 in profit in about 4 months. So I just wanted you to see this so you know that I'm not teaching you something that I don't actually do in the live markets. Okay, so right now let's go over the goal of this video. So the goal is for you to learn this actual strategy, the fair value gap strategy, and you are going to need to trade it for less than 90 minutes after the market opens. So you can trade whatever session you want, New York, London or Asia, and it is going to be only the first 90 minutes, so there is not going to be any need to sit on the charts for hours and hours and hours. So it's going to be pretty simple, straightforward, the first 90 minutes of the session, and that's it, you're done. And what I told you that it's not going to be complicated, because it doesn't need to be complicated. So there's not going to be daily bias, there's not going to be any indicators. So if there is no daily bias, no indicators, there is not going to be any guesswork, because it's going to be very simple. And what I always say is that simplicity is profitability. So let's actually get straightforward into the strategy. So first we need to understand one thing, and that one thing is what is controlling the market. What is the actual thing that is kind of controlling the market? And that thing is fair value gaps. Now I want to add that fair value gaps are not controlling the market literally, but the point is that fair value gaps are going to show us what side of market is getting respected and what side of market is getting disrespected. So it's going to show us exactly where the market actually wants to go, and I'm going to show you how that works later in the video. So first thing is first, this is a fair value gap. So we need in total of 3 candles, as you can see, both bullish and both bearish candles. And for a creation of fair value gap, we need to have this gap from the first candle's wick to the third candle's wick. So this right here is a fair value gap. Same with a bearish example right here, 3 candles, as you can see, from the first candle's wick low to the third candle's wick high is a fair value gap. This right here, red space, and that is fairly simple. So all you need to do on the chart is just practice marking out these fair value gaps. You're also later gonna see me marking it out on the actual real chart. And this right here is the actual picture from the market, and this is how it's gonna look. So you can see right now, for example, if you were to just look at the market, you know that it's quite going to the upside like this, but you don't really know what it's kind of respecting from, what kind of levels is it retesting. But when we draw out the fair value gaps, you can see this fair value gap right here gets retested, and then later on gets retested again, and you can just see how well the market is respecting that fair value gap. And then you can see one more fair value gap right here gets retested, and then one more time like this, and then just bounced back right up. So that means that at this moment market is bullish, but we also have one more confluence that market is bullish that we are later gonna use to profit, and that one point is this. So we can see that these fair value gaps, for example, the bearish ones, the ones that should actually push the market to the downside like this, are actually getting disrespected. And how are we looking at the respect and the disrespect of the fair value gap? So we just determine it whether the body, so this is the body right here, this green part of the candle, whether it closed below or above the bearish candle. So if the body closed right here, leaving a wick like this, this would be a respect, and then we would probably just bounce right back off to the downside. But since we actually closed above the top of this fair value gap, that means that market is going to go to the upside. Same with this one right here, you can see we closed right above, so this is the top of the fair value gap, we closed above it, so that means that market is going to go to the upside. But if we go back to the last slide right here, you can see that this is the body right here, so if it closed below this line, that means that it disrespected and that is going to go lower. And then same thing right here for this fair value gap, this is the low of this fair value gap, this is the bottom, and you can see we never closed below it. So that means that it's still respecting like this, and it just bounced market right back up. Okay, so this is the first and the most important thing to understand, is that fair value gaps are going to show us whether the market is going to want to go somewhere, or it's just going to, let's say, disrespect it and go to the upside when we wanted to see short. So if it disrespects a bearish fair value gap, it's going to go bullish. If it disrespects the bullish fair value gap, it's going to go bearish or even lower. But now even a bigger question is, when the market, let's say, respects a fair value gap, what is it actually going to chase? So what is the market going to chase? And the answer is liquidity. So what is liquidity right now? In the simple terms, liquidity is every single high and low in the market. So you can see this high right here, this low, this high, everything is liquidity. But why is liquidity so important for us? Because on the actual every single high in the market, every single low, every single high, there is going to be stop losses. And what market is always going to chase, it's going to go like this, up and down. It's really kind of unpredictable when you look at it, but when you check out and mark out every single high, every single low, it's very likely to always get swept. Why? Because at this low there was stop losses, so market swept out those stop losses, took the money from the retail traders, then went to the upside, swept out these stop losses, then went to the downside, tried to go back to the upside, but it still manipulated people out, swept out more stop losses. Then here we have more stop losses. So market is always going to chase liquidity, or in better terms, stop losses from all the retail traders. And you can also see right here, market just dumped towards liquidity. So market is always going to try to clear out as much liquidity as possible before making the actual moves. So right now comes the big question: what is going to be the model, what are going to be the steps, and how are we going to enter the position? And this right here is how the model looks like. So right now it may seem a little bit messy, but when we just break it down and go step by step, it's going to be pretty simple. So right now, the first thing, we see that we are making some kind of structure to the upside like this. So this is just a basic structure. We have a fair value gap right here, we also have a fair value gap right here. So this is a fair value gap, you should see that by now if you practiced it. So we have two fair value gaps. What happened? Market came down, it disrespected this fair value gap, but then what happened is we swept this liquidity level. So we stopped out all of the buyers right here, we stopped them out, we respected this fair value gap. So you can see how the body only entered the fair value gap and we closed above it, so we respected it. But then the actual key part actually happened, and that is when we were going to the downside, when we swept liquidity, when we retested this fair value gap right here. What happened is we left a fair value gap here, so you can see a bearish fair value gap. And the logic behind it is, if the market is not going to go to the upside, market is just going to come to it, tap into this fair value gap right here, it's just going to reject off of it back to the downside. And if we get an actual disrespect, so a closure above the fair value gap, what is market very likely going to do? It's going to go to the upside, to some kind of next liquidity level to the upside. So the point is, after we manipulate people out, after we retest this fair value gap right here, if we disrespect a fair value gap that should push the market to the downside, we enter the trade and we target the upside. And that is just why the odds of this strategy are so huge. That is why we have 84% win rate, because it is just so logical. And you can also see right here, we had two setups in this picture that I showed you before. So you can see a fair value gap, you can see liquidity, and then we swept it, leaving a fair value gap that we then inversed or disrespected to the upside. If we enter on the closure and target the upside, you can see beautiful win. And then after that, even one more trade, we have a fair value gap, and then we came down, retested a fair value gap, then we tried to go to the upside, left this wick behind, so we just left this wick right there like this, then we swept it once again, and it was all very close to actually disrespecting this fair value gap, but we continued to respect it. And what happened? This fair value gap, the bearish one, got disrespected, and then after that what also happened is we just went straight to the take profit. So you can actually see how logical this strategy is on the actual chart, and what that means is that right now we are going to go to actual chart example. But before we do that, if you like the video, if you like what I'm teaching you, just go down there, hit that subscribe button just so you see every single video I post, and also like the video. That is just gonna let me know that I'm doing something right. So let's actually get into the chart. Okay, so here we are at the actual live chart. Now everything may seem complicated when we come to the actual real thing, but let's just go over the steps really slowly. So we will always start with the fair value gap, as I told you. So we are actually on the 5-minute time frame, so you want to be doing this thing on the 5-minute, finding the fair value gaps, finding the liquidity, and then the entry model we are just going to scale to the 1-minute time frame after we actually sweep the liquidity and tap into the fair value gap. Then we go down to the 1-minute time frame. So right now we are on the 5, so all we do is we mark out liquidity levels. So you can see this liquidity is already taken before the market opens, so I'm not gonna mark it. But then we have this low right here. I'm gonna mark out all the liquidities that are left. This one right here, you can see I'm gonna mark it out too. And then we have this low down here. So we have in total of 3 lows down here, and then we have 1 high up here. So what are we gonna do? We also need to find fair value gaps. So we found all the liquidity levels. Now we need to find fair value gaps. So we can see that we have a fair value gap right here, but you can see that we have a fair value gap right here that we already are respecting. But the point is, right now the market is about to open, and I want to see some kind of liquidity sweep after the market opens. So you can see right now we are respecting the fair value gap, but it's still not the session hours. So we are going to wait after the market actually opens. So then after that we do not have any fair value gaps right here, and the first fair value gap is this one down here, and we also do have this huge one down here. So we are just going to mark out all the fair value gaps, and that's clearly it. Now we have all the liquidity and all the fair value gaps on the chart. So all we do right now is we just wait for a sweep of liquidity and the respect of the fair value gap. So let's see what actually happens in the market. So market actually dumped, so we can actually right now go to the 1-minute time frame, so we can just check out what exactly is market doing, and we can see that we had a first liquidity sweep. So right now market actually respected a fair value gap and swept all 3 of our liquidity. So what we want to see right now is the thing that I told you. We want to see a fair value gap right here that is gonna actually get disrespected. I'm gonna move this one out of the way. But what is the problem? The problem right now is that we do not actually have a fair value gap. So we do not have a fair value gap right here that we are gonna wait to disrespect and to enter a position. So what do? Is we just wait. We just wait until there is actually a fair value gap. So still no fair value gap, so we just wait, and let's actually see. So no fair value gap still in the market. So all we do is we just wait. We are not gonna be really worried about it. And here is our first bearish fair value gap. So you can see this right here is a bearish fair value gap. So while we were going to the downside, we created a fair value gap. So the thing is, after we sweep liquidity, after we tap into the fair value gaps, we do not need to see instantaneous fair value gap and actual disrespect. I mean, the sooner we get it, the better, but this is completely fine. You can also see on the 5-minute time frame, we are still wicking and totally respecting these fair value gaps that we actually tapped into. So going back to the 1-minute time frame and just waiting for the actual disrespect of this fair value gap. So if we do this, and looks like we wicked through it, we wicked once again. Are we actually going to get the closure? Still no. And let's just wait, and there it is. So once we actually get the closure above the fair value gap, we enter the trade, we put our stop loss below like this, and we target some kind of high to the upside. Let's say, for example, we target this high right here, and that would be total of 4.3 risk to reward. So let's see if it actually hits, and there it goes perfectly to the TP. So what we did is we reacted from fair value gap and liquidity, and then after the inversion of the fair value gap, we targeted liquidity. So A 4.3 risk to reward, it is actually incredible, because imagine if you have a $100,000 funded account, this right here, this trade would result to you making $4.3 thousand. So imagine getting these trades daily or weekly, and that would just be abnormal. Okay, and that's basically it for the video. But before you actually leave the video, I'm actually going to give you something for completely free, which is the PDF of this strategy. So a 10-page playbook of this whole strategy. So if you want to claim it, go down there to the link in the description and just claim it for completely free. Also, if you like the video, make sure to like it, make sure to subscribe to the channel, turn on notifications so you never miss another video. And also the thing is, right now I do have a private one-on-one mentorship, which of course is limited with spots. So if you maybe want to be a part of that, and if the spots are not already taken, make sure to check it out down there, and maybe you actually get to be a part of it. And yep, that's basically it. With all of that being said, I hope you enjoyed the video, and I'm gonna see you in the next one. Peace.